Okay, on this video, we're going to be talking about escrows. Now, that's kind of a crazy word, and it actually has a couple of meanings, but what we're going to focus on today is escrow accounts and how they relate to your monthly mortgage payment. So let's say you purchased a home for $200,000. Let's just throw out some random numbers at it. Let's say your monthly payment on that, total monthly payment, PITI, is $1,800. Now, a significant portion of that is going to be for your principal and interest, which is due to your lender, the person that lent you the money to buy the home. Now, a smaller portion of that is going to be due to some other people for your tax portion and your insurance portion. So your escrow account is basically an account that holds money that you're paying in every single month that is going to be due to other people as a lump sum. So just as a quick example, let's think about your property taxes. Property taxes are due at the end of each year for the full amount of your property taxes. An escrow account is a way that each month when you make your house payment, you can make the portion that's due for your principal, the portion that's due for your interest, and also 1/12, 1 month's worth of what's due for your taxes and 1 month's worth of what's due for your insurance. Now that will be paid into an escrow account that will accumulate throughout the year, and then at the end of the year, whoever's managing or servicing that escrow account will then take that full amount and make one payment to your tax authority or to your insurance company. So escrows are a way to simplify the process of owning a home as opposed to making a bunch of different payments each month or having to have the responsibility and in order to save up the full amount to pay insurance and taxes in lump sums. So just think about escrow accounts as a way to kind of simplify and streamline the process of making your payment obligations based on your house. Typically those escrow accounts are managed and serviced either by the mortgage company that owns your loan or by a service that they hire to do that. So you don't really have to worry about it. You make one payment altogether, and a piece of it goes into the escrow account to cover your obligations for your taxes and your insurance. The positive thing about escrow accounts is that it eliminates having to have the discipline of saving money to the side to make a full lump sum payment for taxes and insurance. There is some downside from an investment perspective. So if you're somebody that wants to earn interest in the advantage, the time value of money on every single penny that you've got, the advantage of not using an escrow account is that you have total control over your money until it's due. So if you're using an escrow account, you're paying a portion of your taxes and insurance each month that's sitting in somebody else's account. If you're keeping it in your own account, you have the ability to invest it or earn interest on it or just have the freedom to have it there as a safety net. So there's some positives and some negatives, but for a lot of folks, it's not an option. For first-time homebuyers, for example, more times than not, the lender's going to require that they escrow. But for a lot of folks, it is an option, and it's important to know the benefits and the downsides.